Kitco Mining special coverage of the Mining Investment Event of the North is brought to you by EMX Royalty Corp.
The capital situation in the mining sector is desperate, warns Jamie Strauss. Jamie is the CEO and founder of Digbee. That is a ESG assurance and data platform. Jamie, welcome to Kitco.
Thanks, Michael. Good to be back.
Now, Jamie, in another interview, you said that mining investment has really dropped despite the run-up in metal prices, despite the push into critical minerals.
Yeah, it's a sad legacy, isn't it? So, yeah, I think we're coming to the end. I think the jigsaw puzzle's being put together, but we've clearly seen, as others have stated on stage here today, a 75-80% fall in our established capital base over the last 15, 20 years. And that really sets ourselves up to some extent for the bull market. But the critical mineral space is only just mobilizing. It's taking some time. In fact, only last week I was talking to a couple of the critical mineral funds, and there's still some inertia in some of these different parts of the world in terms of getting this capital moving, despite the urgency of critical minerals. So I do see the challenges of the last 15 years beginning to run themselves out. We're talking to explorers here. They're still struggling, but there's clearly a new wave of money being mobilized, driven by governments and inspiring private equity and others, which is getting going. But we're not quite there yet, but it's definitely coming.
So what we're talking about here is we're talking about the private sources of funding that are happening as opposed to what's happening in the government. So what we're getting into is this is June right now, 2024, and we're getting about to the 2-year anniversary of the Inflation Reduction Act, which was one of the big pushes that set off to, how would you say, implement critical mineral strategies, because we wanted to get our own reliance on these metals right now and then also use that for energy transition. But we're not seeing any kind of private matching on the other side of this.
Yeah, I think if we go back 2 years to when that happened, what came out of the IRA was effectively debt strategies by government. Yeah. And I think there was a lack of, I'm not part of government, I don't know, but my read of it is that there was a lack of understanding as to how the development markets, the development mining markets operate. We need risk capital to access debt. I mean, that's the reality of capital markets. And I think the government's misplaced that. So what we've then seen since then is a very significant push by governments, whether that's in France with Infravia, in the US, a number of different angles. Germany have got their critical mineral fund, where development capital is now going to be driven by private equity, by risk capital to effectively come in, which therefore then supports that debt provision as well. So if I could go on and say one other thing, it was a really great analogy the other day said to me was, if we go back to the 2000s, we saw the US government very much pushing to clean up the shale gas industry and to create an industry out of that, which was run by mums, pops and promoters. And the private equity guys got going, they put development capital to work, they put structure to work, and they then created portfolios which then sold on to big oil for trillions of dollars. Exactly the same thing is happening. A little bit of a nuance, it's an international thing, not domestic, but it's really exciting to see the jigsaw puzzle beginning to put place there.
Now, is this the responsible investor that you're talking about?
Yeah, this is a good point, and I think there's a lot of confusion exactly what we mean by the responsible investor. I think we have to look at a slight vision going forward here. We're not talking about the established capital which has been driving the mining industry or has been left over from the mining industry the last 25 years or so. I think what we're looking for is a whole new group of capital coming in, and that group of capital is institutional. It's very much taken on sustainability as part of due diligence. You've got supply chain, which is demanding sustainability or responsibility as part of that whole consumer brand capability to go down to the Apples and the Volkswagens or whatever. And I think the kind of key thing here is responsibility is therefore core to due diligence and ultimately therefore creating a much more secure supply chain going forward. So, yeah, this responsible investor is a bit of a myth, but it's really embedded within institutional finance as we get to development finance and ongoing after that.
I want to ask, though, about what we've seen what happened into the nickel market. So we had we had a lot of, how would you say, responsible, working towards less emissions nickel miners. And we've seen that market really kind of hollowed out by what has been happening in Indonesia, which is can be a dirtier nickel.
Yeah, so I think the nickel markets are good. I think this whole Indonesian Chinese angle on nickel is quite interesting because on one hand you can just look at it and say nobody cares about sustainability, and let's not be naive. The auto companies got a big challenge on cost and access to raw materials at the moment, and sustainability has gone down the list from where it was 2 or 3 years ago. But I think there's also a common sense approach to this, and we've also got to tie this in with where China and Beijing are. Beijing announced significant, and ahead of the US statements earlier this year, significant ESG requirements on their top 400 companies, and likewise an encouragement onto their junior exchanges as well. They see this as a long-term building pattern in order to sell their refined product into the West, into Europe with battery passports. And I think we saw Volvo coming out over the last couple of days with clear statement on where battery passports are going to be part of. So the Indonesian thing is a murky situation which not everybody kind of completely understands. But equally at the same time, there is going to be less thermal coal power stations being built in Indonesia. The government has said that. China is demanding more robust sustainability and ESG because of their long-term vision of supplying materials back to the West as part of the supply chain.
There's a myriad of concerns around ESG and sustainability. That could be stakeholder relations, that can be lowering carbon emissions, that can be what type of mine do you leave behind afterwards, how dirty is it, and what is it like to clean up. Are you seeing that there's any particular types of weightings for these types of concerns right now? Is it mostly having to do with carbon emissions, or is it stakeholder relations? What is it?
Yeah, I don't want to go on about this. This could be a long question. I think carbon is still the dominant fact. Global warming is the dominant conversation, and therefore, carbon plays a overweight play in it. But I think sometimes we've just got to look at it from an investment point of view. We've got to look at it and also from a social license point of view. We've got to look at it from the other angle. The mining industry is not going to change its perception in society or finance through the carbon market alone. It's much more important is what happens on the ground. How do we have that social engagement? Ensuring that procurement effectively is much more regional wherever possible, like what Argentina has recently announced. Ensuring that our biodiversity and environmental impact is significantly less than perhaps legacy or historically have been the case. So where I see carbon as important is if we can decarbonize the mining industry, and this is really the producers and new development assets in the future. The explorers really need to ignore this because it's fairly irrelevant from their point of view. But if you look at it from new mines going into production and the current installed production, if we can decarbonize that, then we can lose the penalty that we have to wear when it comes to valuation relative to green sectors or whatever. I mean, just take this into consideration, Michael. A typical brown company of the same size as a typical green company pollutes 260 times more than that green company. So if you remove 1% of carbon in a typical brown company, that's more than 100% for a green company. The impact that we can have in the world on a positive basis by investing in brown companies far outweighs that in investing in technology, in banking or insurance companies, which are as green as they get already. So I think there's a shift coming in the global markets where brown sectors who can have positive impact, and that includes things like aviation as well because of the advances they're making in aviation fuel. But particularly mining, which is working on a multi-spectrum basis in terms of decarbonisation, not only on their own mines, but also Scope 3 further down the supply chain, can have a really significant impact. And that's really important from a valuation point of view, which is really where you were coming from in the beginning.
I had a question regarding measurement of these outcomes, measurement of sustainability. So, I've been in this industry for a while, and what I've noticed more and more is I'm seeing the release of these sustainability reports, and then that being a big issue. But what has been a challenge within it is that actually how do you quantify these? When you release one of these reports, how do you look at whether what they're doing with their carbon emissions and how you compare that against with other miners. Now, we're talking about our friends at Skarn, for instance, which are doing some of this work right now, but how good are we in terms of these sustainability reports? How have they come? And then also, how can you use them in terms of benchmarks versus other mining companies?
Yeah, so I mean, sustainability reports are a problem. And I don't mean that in a negative way, but there's a complete lack of standardization. And this industry continues to fail itself in terms of being able to get its message out clearly in a credible and communicative way. And sustainability reports let us down really right from the beginning. To a large extent, the majority of the companies, and particularly the ones here, the smaller companies, their sustainability reports are a waste of time. You know, there are no readers of these sustainability reports. They're a marketing document which have failed and cost a lot of money. At the other end of the spectrum, you've got the Anglos and the Glencores and the BHPs with sustainability reports, where I think they're genuinely trying to do a good job, but there's no harmony. There's a very difficult way to be able to simply compare, contrast one company against another. They all do it a different way. Certainly Digbee's point of view is to try and bring all this together on an independent assessment and to allow stakeholders to then be able to compare and contrast in a standardized way. But that's not to say that we would replace a sustainability report. We would better enhance that sustainability report, which then means the ESG rating agencies then have a better source of information with which to read.
You provide ESG services at Digbee. Are you noticing any differences in terms of the demand for your services from different sectors, either like different minerals that they're mining or say a different sector?
Yeah, I mean, we're definitely seeing, and it really comes back to, I suppose, the capital side of things. We're definitely seeing a big push by the developers, anybody from a scoping study or PEA upwards, to really getting ahead of the curve and trying to prepare themselves for due diligence going forward. And they're definitely that segment of the market is definitely showing significant interest to us. In terms of commodities, I mean, bizarrely, the rare earth, the graphite companies, obviously gold because they're a major part of the universe, have really come forward. But I think that's just by chance. I don't think it's anything in particular reason. We're agnostic. We could do a thermal coal company all the way through to obviously lithium and anything. So I think it's very much broad-based, but it is very much the developers and early producers who are trying to get that message across and earn their credibility.
How can development stage companies prepare for investor discussions?
Yeah, I mean, if you look at if you go out and talk, which obviously I do, to different types of investors, and they're generalists, and I think that's really key. It's an interesting discussion from earlier here today. Is I think the industry continues to look internally and not ask externally as to what are, in the case of generalists particularly, what are they looking for in order to increase their trust in this sector and therefore begin to deploy capital. They're looking to offset their reputational risk within the mining sector. It's been a big problem for them. They don't have to invest in the sector. It's less than 3% of the S&P, so they can effectively leave it at the moment. But if we ask them what they need, what they would like to have in order to offset their reputational risk, particularly these younger fund managers, millennials or Gen Z or whatever it happens to be, then I think we're going to get a lot more support from that. To come back to the private equity world, which is where most of the money is at the moment for development capital, how can they best prepare? Look, Michael, they've got to go through Equator, they've got to go through IFC in order to get hold of this capital. How can you preempt that? How can you work out what are the potential risks in order to do that? How can you improve the efficiency to go through Equator and IFC? Going through Digbee allows you to get ahead of that curve, to be able to take action and strategize on particular issues, and therefore be able to go through that Equator and IFC process much more efficiently.
When you've gone through the steps, what's the value that's been added to the company?
Yeah, that's multifaceted. I mean, clearly there is beginning to be certainly efficiency of getting through to that due diligence, which is a cost of capital. I'd like to say that within the next year or 18 months, you're beginning to see a lower cost of capital. But ultimately, it's getting getting up to speed on getting into offtakes quicker, being able to present your capability in a much more robust way, in a much more efficient and quicker way in order to get your deals. I mean, this sector is going to be driven by collaboration. I mean, with the critical minerals industry, less so with gold, but I mean, with the critical mineral industry, it is multifaceted offtakes, supply agreements like Caterpillar and others like that, and then obviously multifaceted debt and equity and streaming and royalties. So how can we get all of this due diligence over in a very efficient way in order for everybody to be on page at the same time and have de-risked that project ahead of time before we go to that?
Jamie, thanks for your time.
Thanks very much indeed, Michael.
My name is Michael McRae here at the Mining Investment Event of the North for Kitco Mining.
Kitco Mining special coverage of the Mining Investment Event of the North is brought to you by EMX Royalty Corp.